New Jersey is the market that refuses to blink. Prices keep rising, buyers keep bidding, and the squeeze on affordability grows louder by the month. Start with the numbers. Across the state, the median sales price climbed 5.4% last year to $525,000. Demand held steady into January of this year, and momentum is expected to increase. That's happening despite mortgage rates that, at one point, rose as high as 7.8%. Many owners sit on an average rate near 4%, reluctant to trade a cheap mortgage for a more expensive one. But expectations point to rates drifting lower, and that subtle move can change everything. More homes listed, more deals done, more buyers stepping in. This sits atop a deeper structural problem. New Jersey's property taxes and home values are among the highest in the country. Advocates call the affordability gap astronomical, a mismatch between what people earn and what they must pay just to live. Even when buyers are creditworthy and carry down payment assistance, the properties they want can sit beyond reach. If you add subprime lending, where a family might be offered a mortgage at a much higher cost if their credit isn't top tier, the danger rises. Payments that start manageable can shift higher over time, and that's when people land in foreclosure. Why is supply so tight? The state's builders point to home rule and exclusionary zoning, a long trail of regulations, and development timetables that stretch. Those delays and costs deter investment. When homes finally do get built, too many are luxury. Not enough are affordable, either to rent or to buy. Yet, demand doesn't leave. New Jersey is anchored between Philadelphia and New York City, and the draw is real. Single-family homes are moving. Adult communities are active. The condo market, too. Even people who pulled back over the last couple of years are now back out looking as rates ease. Zoom in on the map and the story sharpens. In Deal, a small borough tucked into the New York Jersey City metro, the typical home value reached $4,212,865. In 12 months ending January, that was a jump of $412,280, up 10.8%. Over 5 years, that's a $2,007,740 increase, a rise of 91.0%. Alpine shows the same intensity, $2,955,120 typical value, up $321,208 in 1 year, a 12.2% surge, and a $1,003,916 climb over 5 years, or 51.5%. Along the coast in Bayhead, typical value hit $2,362,175, up $240,903 in 12 months, an 11.4% leap, with a 5-year climb of $896,644, or 62%. Lock Arbor pushed to $2,880,432, rising $231,775 in a year, an 8.8% move, and $1,387,939 in 5 years, a 93.0% climb. Saddle River touched $2,210,648, up $226,124 in a year, 11.4% higher. Girt crossed $2,304,930, higher by $211,955, up 10.1% in those same 12 months. These aren't one-offs. They're the leading edge of a statewide pattern. Demarest vaulted to $1,411,000, surging $184, surging $183, $282 in a year, an eye-opening 14.7%, the kind of single-year move that once felt unthinkable. Franklin Lakes climbed to $1,517,266, up $157,124, a rise of 11.6%. Mantoloking reached $1,969,772, adding $149,133, up 8.2%. Short Hills sits at $2,258,188, up $138,052, a 6.5% gain with a 5-year rise of $828,873, 58.0%. Englewood Cliffs is at $1,690,452, up $133,234, an 8.6% increase. Spring Lake checks in at $1,355,039, up $130,201, a 10.6% push. Summit is $1,299,787, rising $117,579, a 9.9% increase. Essex Fells reached $1,409,218, up $114,603, an 8.9% climb. Rumson stands at $2,126,098, adding $115,538 in 1 year, up 5.7%. Travel the state and the mid-tier markets are moving too. Palisades Park posted a $961,033 typical value, up $74,981, a jump of 8.5%. Woodcliff Lake is at $1,193,599, rising $72,448, or 6.5%. River Edge hit $811,599, up $69,621, a 9.4% surge. Haddonfield, part of the Philadelphia-Camden-Wilmington Metro, reached $807,328, up $62,505, an 8.4% increase. Oradell came in at $951,635, rising $62,646, or 6.9%. Montclair rose to $1,102,512, up $68,186, a 6.6% rise. Glen Rock reached $1,011,530, adding $70,541, a 7.5% move. Florham Park checked in at $996,992, up $74,754, 8.1% higher. South Orange posted $1,036,999, up $77,944, also 8.1% higher. Westfield rose to $1,226,968, up $77,572, a 6.7% gain. The shore towns are a chapter of their own. Ship Bottom, on the New York-Newark Jersey City Metro coast, climbed to $1,429,294, up $96,115, a 7.2% rise. Stone Harbor, in the Ocean City Metro, reached $2,477,217, up $95,422, a 4.0% gain. Long Beach Township moved to $1,970,933, up $82,236, up 4.4%. Beach Haven posted $1,633,544, up $78,198, 5.0% higher. Cape May Point hit $1,474,306, rising $78,638, up 5.6%. Margate City rose to $1,056,909, up $72,558, a 7.4% jump. Avon by the Sea reached $1,653,487, up $71,861, 4.5% higher. Upper Saddle River is $1,373,140, up $70,473, 5.4% higher. Mountain Lakes stands at $1,161,670,000, up $70,024, a 6.4% move. Step back and compare this to the country at large. The typical home value in the United States sat at $358,968 in January, just 0.2% higher than a year before. New Jersey's upper-tier markets didn't just outpace that, they lapped it. In Allenhurst, typical value hit $2,218,522, up $176,971 in 1 year, an 8.7% jump, and the 5-year change is staggering, $1,127,742 higher, a 103.4% rise. Bay Head's 5-year build of $896,644 is 61.2%. Long Beach Township's 5-year move stacks to $803,155.60, 8.8%. Strathmere, part of the Ocean City area, posted a 5-year gain of $624,541, 68.6%. Deal's 5-year climb at $2,007,740 is a 91.0% transformation. These numbers feel abstract until they hit the street. On the ground, the state's top sellers are matching the moment. One luxury team sold a fellow broker's home for more than $250,000 above its prior list price. That same group represented 7 of the 10 most expensive residential sales on the New Jersey Multiple Listing Service across 2024 and 2025, and they've surpassed $600 million in closed transactions. Another builder-led firm reports over $100 million in projects underway and claims it cut what used to be a 12-month build timeline down to 7 months by restructuring workflows with technology, an acceleration that could, if replicated, ease some bottlenecks in supply. In Bergen and Hudson counties, one agent with more than 500 closed transactions notched an above-list offer on a Cliffside Park condo in just 24 days. At the opposite end of the price spectrum, a Sussex County specialist works everything from $70,000 starter condos to 7-figure homes, proof that demand runs the full ladder. But affordability keeps pulling the rope. The statewide median of $525,000 carves a line. Towns like Westfield at $1,226,968, South Orange at $1,036,999, and Glen Rock at $1,011,530 sits solidly above it. Even in communities closer to the median, River Edge at $811,599 or Haddonfield at $807,328, the 1-year gains are material, 9.4% and 8.4% respectively. The gap between rising prices and household budgets doesn't close by itself. It widens further when riskier loans push buyers into higher-cost mortgages if their credit profile is not pristine. The trap is familiar. Payments start affordable, then step up, and a missed payment can set off a dangerous chain reaction. Underneath all of this is supply. Home rule and exclusionary zoning limit what can be built and where. A high regulatory environment inflates costs and stretches approval timelines, and a slow, inefficient process ends up costing everyone more. Developers say those friction points shrink investment into the state, and when new housing does come online, it often lands at the top of the market. More luxury, less attainable. Meanwhile, New Jersey's property taxes add a steady pressure on both builders and buyers. There's a policy crossroads, too. State leadership faces old choices with new urgency: raise taxes to cover higher costs, or cut programs and risk harming those who rely on them. Some advocates are pushing for a community reinvestment law at the state level, echoing a federal framework to require banks that profit in New Jersey to invest equitably in local communities and affordable housing development. Others point to the last election as a pivot, where voters put the shortage of affordable housing at the center, and there's hope a new governor and legislature will focus on unlocking supply. Uncertainty out of Washington hasn't knocked this market off course in the short term. Concerns over tariffs and national politics tend to ripple through the stock market quickly. Housing moves slower. The lock-in effect is the drumbeat. With many owners sitting on roughly 4% mortgages, while recent rates spiked up to 7.8%, they've had a strong reason to stay put. Now, as rates drift down, the calculus changes. Sellers who stayed quiet may list. Buyers who waited may engage. Statewide demand already held steady as of January, and the expectation among practitioners is that it strengthens this year. If that plays out, the numbers we're seeing in the towns with the fastest-growing values may not be anomalies. They may be a blueprint. The blueprint is diverse. In Wyckoff, typical value is $1,091,109 after jumping $85,284 in a year, an 8.5% increase. Chatham reached $1,266,015, up $101,726, an 8.7% gain. Interlaken posted $1,505,655, up $102,970, 7.3% higher. Ho-Ho-Kuss landed at $1,237,421, up $95,013 in a year, an 8.3% rise, with a 5-year gain of $412,500, or 50.0%. Brielle is at $1,219,273, up $95,106, an 8.5% year-over-year jump, and $493,872 higher across 5 years, a 68.1% climb. Ship Bottom's 5-year increase is $554,605, 63.4%. Cape May Point adds $534,705 across 5 years, 56.9%. Girt raised $1,012,689 in 5 years, a 78.4% move. Even where 1-year percentages are smaller, Stone Harbor's 4.0%, or Long Beach Township's 4.4%, the 5-year trendline angles sharply upward. Meanwhile, commercial real estate in the region sketches its own backdrop. The national office vacancy rate sat at 18.5% in November, 90 basis points lower year over year. The national average full-service equivalent listing rate for office space was $32.77 per square foot. About 32.2 million square feet of offices were under construction at the start of December, a pipeline 44% smaller than a year earlier. In other words, planned and active projects now amount to less than 2% of national office stock, down from around 3% a year before. That's a sharp contraction in new supply. Yet the office sector is not frozen. Co-working expanded, opening 22 million square feet in 2025, a 16% increase from the year before. Its market share rose by 30 basis points to surpass 2%. The hybrid model has momentum. Signals suggest that because about 2/3 of firms offer some location flexibility, co-working is filling the gap between fully remote and full-time office work. It's a bridge product, cheaper and more flexible than a long corporate lease, more connected than working from home. The Northeast sits at the point of this spear. In Manhattan, the average full-service equivalent office listing rate reached roughly $60 to $8 per square foot in November, far above the national average. Boston followed in the region at close to $49 per square foot. Philadelphia asked nearly $32 per square foot, the only major northeastern market with office rates below the national average. Development is concentrated as well. Office projects under construction in Boston totaled a little more than 4.1 million square feet, while Manhattan had close to 3 million. Combined, those two pipelines make up about 22% of the country's roughly 32 million square feet under construction. And sales? Manhattan led the nation through November with nearly $7.30 billion in office deals, averaging $514 per square foot, almost triple the national average of $190. Boston saw nearly $1.40 billion at about $171 per square foot. In New Jersey, office transactions added a little more than $1.20 billion at an average sale price of $156 per square foot. That's a sober reminder. The economic engine turning across the Hudson and spanning into New Jersey remains powerful, but it has shifted shape. Office-using employment wobbled late in the year, with an October decline of about 30,000 jobs across professional and business services and information sectors, offset in part by a 10,000 job gain in financial activities. Year over year, office-using sectors still added around 188,000 jobs, a modest 0.5% rise. That doesn't roar. It hums. Signals suggest these commercial currents ripple into housing choice. Hybrid work and co-working expand where and when people need a full-time commute. For a buyer in South Orange or Montclair, where typical values are $1,036,999 and $1,102,512, each up 8.1% and 6.6% in a year, the ability to go into the city some days and work from home others is more than a lifestyle. It's a budget lever. In River Edge, up 9.4% year over year to $811,599, or in Palisades Park, up 8.5% to $961,033. That lever might be the difference between buying now and waiting. Still, demand is larger than hybrid. New Jersey draws buyers because it is New Jersey close to New York City and Philadelphia, anchored by schools and communities, with the coast stretching from Long Beach Township at $1,970,930, $3 to Cape May Point at $1,474,306. In the New York-Newark Jersey City metro bracelet of towns, Ridgewood at $1,161,944, up $82,214 or 7.6%. Gloucester at $1,119,740, up $78,487 or 7.5%. Glen Rock at $1,011,530, up $70,541 or 7.5%. Competitive bidding is not just a news cycle. It's Tuesday. The luxury tier keeps rewriting its own chapter. Manteloking's $1,969,772 is not even the ceiling. Stone Harbor holds $2,477,217, and Short Hills is at $2,258,188. Saddle River sits at $2,210,648. Rumson at $2,126,098, Allenhurst at $2,218,522, Girt at $2,304,930. In the uppermost tier, Lock Arbor at $2,880,432, Bay Head at $2,362,175, Alpine at $2,955,120, and Deal at $4,212,865 shape a corridor where one-year price changes are six figures, and five-year jumps range from the high six figures to multi-million-dollar leaps. This isn't to say every town sees double-digit gains in a straight line. Some registered 4% to 6% increases over the 12 months ending in January. But across the strongest pockets, 8 to 15% became normal. Ho Cuss up 8.3% to $1,237,421. Westfield up 6.7% to $1,226,968. Milburn at $1,203,250, up 7.0% in a year, and $431,752, 56.0% over 5 years. Mountain Lakes at $1,161,670, up 6.4%, with a 5-year climb of $342,046, or 41.7%. Upper Saddle River at $1,373,100, $140 up 5.4% in a year, and $397,071, 40.7%. Over 5,000 at the shore, the 5-year changes are even more dramatic. Harvey Cedars reached $2,112,184, up $151,054 in a year, a 7.7% gain, and $829,465 across 5 years, a 64.7% jump. Long Beach Township added $803,155 in 5 years, up 68.8%. Beach Haven climbed $644,225 over 5 years, a 65.1% surge. Barnegat Light pushed up $597,904, a 60.8% move. Ship Bottom added $554,605, up 63.4% in 5 years. These are not flukes, they're arcs. Even with this heat, there's a grounded rhythm to the market. Agents who treat transactions as life transitions, selling a 40-year family home, downsizing, buying the first place, are thriving by aligning people with these hard numbers. In Bergen and Hudson counties, guidance wrapped in data can secure an above-list contract in 24 days. In Tenafly or Franklin Lakes, a refined marketing push can pull a stalled high-end listing over the finish line, sometimes $250,000 above a prior list price. For builders, shaving a construction cycle from 12 months to 7 is more than speed. It's carrying cost relief, risk reduction, and earlier delivery into scarce inventory. The friction is not just financial, it's structural. Home rule and exclusionary zoning keep production tight. The regulatory gauntlet slows approvals. Property taxes add an ever-present weight. The result, a shortage of affordable homes to rent and buy. Advocates argue for a smoother development process. Economists press for expanding supply. Lenders face calls to invest more equitably in the places where they make their money. The choices are real. New Jersey's leadership will weigh them with a magnifying glass on affordability. Even so, the short-term pulse remains clear. People want to live here. Location, lifestyle, and the gravitational pull of New York City and Philadelphia keep New Jersey's demand base wide and deep. As rates drift lower from the 7.8% peak towards something closer to what buyers can accept, pent-up sellers with 4% mortgages will face a choice. Some will list. More buyers will find a payment that works. That can lift transaction counts even if price growth cools from double digits into something slower. Context matters. Manhattan's office story, $7.30 billion in sales through November at $514 per square foot, suggests the region's core is still heavily capitalized. Boston's $1.40 billion at $171 per square foot, and New Jersey's $1.20 billion at $156 per square foot signal a regional commercial backbone that is adapting rather than dissolving. Hybrid work reshapes where firms spend on space. Co-working adds 22 million square feet in a year, up 16%, crossing a 2% share with a 30 basis point jump. Hiring in office-using sectors is not booming, but net positive year over year by around 188,000 jobs. In that environment, families reconsider the radius of their lives. Signals suggest that the choice to live in Chatham at $1,266,000 or in Florham Park at $996,992 is less tethered to a daily commute and more balanced against school, space, and cost. Where does this go next? The base case for the next 12 months. A steady year that leans strong. Expect demand to tick up as rates inch lower, pulling more inventory onto the market from owners who sidelined plans when 7.8% looked immovable. Transaction counts should rise. Price growth likely persists but varies by town. Single-digit to low double-digit increases in the most supply-constrained places, and mid-single digits where gains already ran hot. The luxury belt, from Short Hills at $2,258,188 to Girt at $2,304,930 and Deal at $4,212,800 $865, remains tight and active. Two watch items belong on every dashboard. First, the interest rate path across the next 4 quarters. The lock-in effect comes from owners with about 4% mortgages. If market rates fall enough to close that gap, inventory could increase, competition could intensify, and bid-up behavior could return in pockets. If rates stall too high, supply remains caged, and affordability tightens further. Second, the policy lane. Movement on zoning reform, streamlined approvals, or a state-level community reinvestment law could influence the pipeline of new homes and, over time, bend the affordability curve. If the development process becomes more efficient, even shading months off timelines, builders can bring more than luxury to market. If it doesn't, luxury will continue to lead and the median buyer will run in place. The through line is resilience. New Jersey's median price at $525,000 is a high bar, yet towns like South Orange at $1,036,999 and Westfield at $1,226,968 are still drawing multiple offers. At the Shore, Ship Bottom at $1,410,9,294 and Beach Haven at $1,633,544 keep ratcheting up. In the north, Alpine at $2,955,120 and Demarest at $1,411,184 reset ceilings. Across the state, Haddonfield at $807,328 and River Edge at $811,599 show that sub-million-dollar towns aren't spared from fast gains, 8.4% and 9.4% year-over-year respectively. And in the extremes, Deal adds $412,280 in 1 year, Lock Arbor adds $230,1,775, and Allenhurst stacks $1,127,742 across 5 years. The paradox persists. High taxes, high prices, yet still high demand. In a market like this, precision matters. If you're a buyer, it's not enough to know the state median. You need to know that Margate City is at $1,056,909, up 7.4% in a year, and that Mantoloking sits higher at $1,969,772, up 8.2%, while Avon by the Sea posts $1,653,487, up 4.5%. If you're a seller, you need to understand whether your town looks more like Summit at $1,299,787, up 9.9%, or like Stone Harbor at $2,477,217 with a steadier 4.0% rise. If you're a builder, cutting a timeline from 12 months to 7 can turn a project from marginal to feasible in a state where carrying costs and taxes drag. Throughout the next year, listen for inflection points, watch mortgage applications as rates inch down, track new listings as locked-in owners reconsider. Keep an eye on legislative signals about development and community reinvestment. The office backdrop will continue to evolve. National vacancy at 18.5%, listings around $32.77 per square foot, Manhattan asking near $68. Co-working's 22 million square feet of new openings is a barometer for how people and firms are reorganizing work. Signals suggest that reorganization shapes the radius of where New Jersey lives. If the economy holds its balance, with office-using sectors netting around 0.5% more jobs year over year, with Manhattan and Boston carrying 22% of the national construction pipeline between them, the region's housing markets should keep moving. If unpredictability in Washington rises, tariffs or policy swings could ripple over time. But housing tends to absorb shocks slowly. In the short term, the engine runs on rates, supply, and the magnetic pull of a state that bridges 2 major cities and stretches to the sea. Here's the bottom line. New Jersey's housing paradox is not going away. A median at $525,000. A luxury lane where Alpine at $2,955,120 and Deal at $4,212,800 $865, post six-figure yearly gains. A mid-tier where River Edge jumps 9.4% to $811,599, and Haddonfield climbs 8.4% to $807,328. A coastline where Beach Haven is $1,633,544, and Long Beach Township is $1,970,933, both riding multi-year waves. Behind it all, a supply stack constrained by zoning, regulation, and taxes, with new construction too often landing at the top. In between, a fierce desire to live here and the slow unwinding of a mortgage lock-in as rates ease. For the next 12 months, expect steady strength. Rate drift lower. More listings. More closings. Persistent pressure on prices where supply is tightest. Two levers to watch: the interest rate path and the policy choices that either unlock or choke supply. If either shifts decisively, the market's cadence changes. If not, the numbers we see today will echo into next year, higher in some places, steady in others, but rarely soft. Stay with us to track New Jersey's market with the same clarity, hyperlocal values, month-by-month momentum, and the hard numbers that move decisions.